In chapter 4, we're going to talk about futures contracts, and we're also going to talk a lot about how to hedge risks, both using futures or forward contracts. Futures contracts are defined very similarly like forward contracts. They are an agreement to trade an underlying asset at a fixed futures price at the maturity date capital T. And again, as with the forward contract, the futures price F, so we denote it by the same variable, is at time small t. When you sign that futures contract, it's chosen such that the present value of these payoffs of the future are equal to 0. Or in other words, the contract for both the long and the short position is worthless. The differences between futures contracts and forward contracts are, on one side, the organization on the market. So futures are traded on exchanges, while forwards are traded over the counter. And the second crucial difference is the timing of the cash flow. So you remember with forward contracts, you were waiting until the very end of the contract, so until the maturity date, and then payoffs between long and short positions are made. For futures contract, we use something called marking to market or daily settlement. And the idea is that in order that there's never going to be any credit risk, you reset the value of futures positions at every day to 0. The way you do that is you determine at the end of the day the new futures price, which is set again such that for both long and short positions, the present value of future payments are 0. And then you look at by how much futures prices have changed during the day, and then payments between long and short positions are made accordingly. Let me make this point with the daily settlement a little bit clearer, and let's move to the virtual whiteboard. Let's draw a timeline from time small t to time capital T. And at time small t, that's also day S0. Then we draw here the first day S1, the second day S2, the third day S3, and so forth to day Sn-1, and then day capital T is day Sn. So we have here n days from time small t to time capital T. If I take a long position in the futures, then at the initial date, there is a 0 cash flow when I enter the position. And now after the first day, we will look at what is the futures price at time S1, and we'll take the difference to the futures price which I have locked in back at time small t, and that's exactly the cash flow to the long position. So in other words, you kind of close the futures position which he has entered back at time small t, and you realize that payoff, and then you reopen a new long position in that futures. Then after one more day, you look again at what is now the futures price at time S2, and you take the difference to the futures price on the previous day. And again, that will be the cash flow to the long position. Again, the idea here is that you reset again the value of your position to 0, and you want to exactly pay off that accumulated value between S1 and S2. If you go to the third day, again, you look at what is the futures price at time S3, and you take the difference to the futures price on the previous day. And again, the long position just gets that difference in these values. And so effectively, the long position closes the previous position and reopens a new position with futures price F at time S3. And so you can keep going like this. At time Sn-1, the payoff is going to be the difference between Sn-1 and Sn-2. And at the final date, it's going to be F at time capital T minus F at time Sn-1. Notice now that if I add up all these cash flows, then F at time S1 cancels out over here. F at time S2 cancels out over here. And so forth, I can keep going. And all these cash flows are going to cancel out. And what I'm left with is just the futures price at time capital T minus the futures price at the initial date when I enter the long position. Now notice that the futures price at time capital T, that's exactly the same as the price of the underlying asset at time capital T. Well, the reason is the futures price at time capital T is really an agreement to trade the underlying asset right now at time capital T, and therefore the price which you lock in to trade right now, that underlying asset, that should be just the value of the underlying asset. If this futures price would be any different from the price of the underlying asset, then you can get an obvious arbitrage. If this is larger than the price of the underlying asset, then I would want to buy it in the market at this price over here and sell it in the futures at this higher price. Similarly, if F is less than S, well then I agree to take the long position to buy the underlying asset at this price and immediately sell it in the market at the higher price. So the only way that there's no arbitrage is if these two numbers are exactly the same. So now let's look at these cash flows, and you see that taking a long position in the futures really has the same payoff as the forward contract. Now there's one caveat here. Notice that when we have these daily cash flows, we actually ignored that we could reinvest them at the risk-free rate until to the maturity date. So here we did something very simple. We just add up all these cash flows, ignoring all the reinvestment. So really what I wrote over here is just true if the risk-free interest rate is 0 throughout the entire time horizon. In a minute, we're going to talk about what happens if the interest rate is not 0. Notice that when we look at the short position, then we just do the opposite. So again, in the beginning, we have a 0 cash flow. Now the short position earns money on the first day if the futures price decreases. So then the payoff is the initial futures price minus the futures price at time S1. So meaning that if the futures price is lower at time S1, then I get a positive cash flow as the short position. And so again, what was the idea? With a forward contract now, you would have a positive present value for your short position of locking in the price at time small t. And so what we do here is, again, we reset the value of your futures position to 0, and therefore the short position gets a positive cash flow right now. Then at time S2, again, we look at the difference in the futures prices by how much it changed from time S1 to time S2. Similar at time S3, we look at how much the futures price changes from S2 to S3, and we keep going. And again, adding up everything and noticing that all these prices over here drop out. And we're only left with the initial futures price minus the futures price at the very end. And again, noticing that the futures price at the very end is the price of the underlying asset. Well, then this looks again the same as what we had for a forward contract. You deliver the underlying asset, and therefore you have a negative cash flow of ST dollars, and you receive that promised futures price which you have locked in. Again, notice that there's this caveat that actually all these reinvestments of the daily cash flows are done at a 0 interest rate. That's why we can just sum them up. If the interest rate is actually non-zero, well, then these cash flows grow at whatever this interest rate is. And again, we're going to talk about that just in a minute. On pages 3 to 7, I derive a derivation of the futures price, but I want to turn to the virtual whiteboard to show this derivation in more detail. We start by drawing a timeline from small t to time capital T. And the difficulty now is that we actually have cash flows on a daily basis. So we have to also draw all these daily time steps from time small t to time capital T. So we start at time small t, we denote that as day 0, denoted by S0. Then the first day will be S1, and then the second day will be S2, and then we can have many days in between, and then let's say a maturity that's Sn for the nth day. At the initial point in time, we borrow an amount of money equal to the futures price, which means that today we receive F dollars, and then we have to pay that back plus interest at time capital T. And notice that I just write R without any time subscript. The reason is because in our derivation now we assume that the interest rate is constant from time small t to time capital T. Then we buy e to the power of the interest rate minus the cash flow yield times number of years until to maturity units of the underlying asset. Each unit costs today ST dollars, so number of units times ST, that's the negative cash flow which we have to buy these assets. we hold on to these assets and reinvest any cash flow Q such that at the final date we end up with e to the power of r times the time horizon between small t and time capital T units of the asset. And this is worth S at time capital T dollars per unit times the number of units e to the power of r times capital T minus small t. Finally, we take a short position in e to the power of r times st minus small t, so that means a time horizon for 1 day, units of the futures contracts. Entering short positions in futures doesn't have any cash flow today, but after the first day, one short position in the futures will earn money if the futures price decreases over that first day and loses money if the futures price increases over that first day. That means the payoff per one short position in the futures is the futures price at the initial date S0 minus the futures price at day 1. And now we don't have one short position in the futures, but e to the power of r times S1 minus t. Notice here that the futures price at time S1, that's again set such that if you enter at that date a futures contract, the present value of that position is exactly 0. So that payoff at time S1 reflects exactly that the value of the futures contract is reset to 0. Now at the first day S1, we want to invest the cash flow which we receive at time S1 in the risk-free asset until time capital T. That means if it's a positive cash flow, then we actually lend that amount of cash until time capital T. If it is a negative cash flow, then we borrow an amount exactly to cover that negative cash flow until time capital T. That means we have a negative cash flow of f at time S0 minus f at time S1 times that e to the power of r times S1 minus t. And this grows at the risk-free interest rate r until time capital T. And we see here now why it is important that the risk-free rate r is constant from time small t to time capital T, because we entered exactly this many short positions, which depends on that risk-free rate r, such that we can reinvest that cash flow over here at the risk-free rate r, and then we end up exactly with that difference in futures prices multiplied by e to the power of r multiplied by capital T minus small t. So the idea is that this number of positions now multiplied by the interest which we earn adds up exactly to an amount which does not depend on time S1 anymore. In addition, at time S1, we also change our short position in the futures to e to the power of r times S2 minus t short positions. That has no cash flow implications today, but at time S2, now the payoff is going to be, again, the difference in the futures prices times the number of futures contracts which we have open. At time S2, we invest the cash flow which we get from the short futures position until time capital T at the risk-free interest rate R. That means we have a negative cash flow of f at times S1 minus the futures price at time S2 times e to the power of r times S2 minus t. And this grows at the risk-free rate r until time capital T to f at time S1 minus f at time S2 times e to the power of r times capital T minus small t dollars. And again, we change the open futures position to e to the power of r times S3 minus small t short futures positions. That has a 0 cash flow at time S2 and will have a cash flow at time S3. And then we keep going like this until time Sn. Now finally we can look at the cash flows at each day. So at the initial date, small t, our cash flow is going to be that borrowed amount of money minus how much we had to pay to buy the underlying assets. At time S1, the payoff from the futures position which we have opened a day earlier is reinvested until time capital T. And then we adjust our futures position, but that has a zero cash flow implication. So this adds up to a zero cash flow. Similarly, at time S2, the payoff which we get from the short futures positions is reinvested until time capital T. Then the adjustment in the futures position doesn't cost us anything. This again adds up to a zero cash flow. And then finally, at maturity, we have to pay back the borrowed amount of money plus interest. We have a position of underlying assets after reinvesting all the dividends. And then we have the sum over all these futures payoffs which were reinvested until time capital T for each day. Notice that I factor out this term e to the power of r times the time horizon between small t and time capital T. Then this is the money which I have to pay back because I've borrowed money initially. This is the value of the underlying assets which I'm holding. And these are all the cash flows from the futures position on day 1, day 2, and so forth until day Sn. Now the key thing to notice is that FS1 cancels out over here. Similarly, FS2 will cancel out with the next day's payoff, and so forth until FSN minus 1 cancels out. And you're only left with the futures price at the very beginning and the futures price at the very end. Then we plug in for S0 equal to small t and for Sn equal to capital T. And we notice that by no arbitrage, the futures price at time capital T is exactly equal to the price of the underlying. This must hold because a futures at time capital T, which expires immediately, is an agreement to trade the underlying asset right now. Well, then that futures price has to be the price of the underlying asset right now. So if I plug in everything, what I end up with is e to the power of r times capital T minus small t multiplied by the amount of money which I have to pay back from the borrowed amount, plus the value of the assets which I hold, plus the futures price at the initial point when I took first short positions, minus the futures price at the very end, which again is equal actually to the price of the underlying asset at time capital T. And therefore, we notice now that this term cancels out over here, and S at time capital T cancels out with that futures price at time capital T, and we're left exactly with a zero cash flow. So you notice now we have constructed a strategy which always has a zero cash flow on every day until to the maturity date. And therefore, since all these cash flows are equal to zero, it must be that the initial cash flow is also equal to zero. This is by no arbitrage, and that pins down the futures price, which is now equal to the price of the underlying asset times e to the power of the risk-free interest rate minus the cash flow yield Q times the time horizon to maturity. You notice that the futures price therefore is exactly the same as the forward price. But again, remember here that we had one crucial assumption, and that's that this interest rate R is constant, and that was needed such that cash flow which we receive after the first or after the second day after reinvesting it, we can cancel out that term S1 or here S2, so that everything is multiplied just by this constant term e to the power of r times capital T minus small t. Therefore, we say the futures price is the same as the forward price as long as the interest rate is constant during the lifetime of the futures contract. Notice that we also can derive the same formula where the futures price takes the same form as the forward price if the interest rate is stochastically changing over time, so meaning that the interest rate randomly can increase or decrease, as long as these changes in the interest rates are uncorrelated from the changes in the futures price. Now, it turns out that if there's a positive correlation between the interest rate and the futures price, then the futures price will be higher than the forward price. To understand this, let's go back again to our derivation in the virtual whiteboard. A positive correlation means that when R is relatively high, then the futures price at time S1 is larger than the futures price at time S0, and this means that this term here in parentheses is negative. Similarly, if the interest rate is relatively low, then the futures price at time S1 is less than the futures price at time S0, and therefore this term in parentheses is positive. So that means that any positive cash flow is multiplied by a relatively small term, and any negative cash flow is multiplied by a relatively large term. So therefore, adding up now these cash flows means that we end up here with something smaller than zero, so a negative cash flow. But since this strategy which we implement here causes zero cash flow at every day, but now a negative cash flow at the final date, this must mean if there's no arbitrage, then the initial cash flow has to be positive to compensate that negative cash flow in the future. And this means that the futures price, therefore, has to be somewhat larger than this term over here, or larger than the forward price. And this is exactly what this statement over here says. Similarly, if you have a negative correlation, that means that the futures price has to be less than the forward price. Let's look again over here on the virtual whiteboard. With a negative correlation, if the interest rate is high, that means that the futures price at time S1 tends to be less than the futures price at S0, and therefore this term is positive. If the interest rate is low, then the futures price at S1 tends to be higher than the futures price at S0, and therefore this is going to be negative. So now we weight the positive cash flows with a higher interest rate and the negative cash flows with a lower interest rate. So therefore, if you add up all these future payoffs reinvested until time capital T, now this overall payoff tends to be positive. And so again, since all the intermediate cash flows are zero, we have a positive cash flow at the very end, then it must mean, if there's no arbitrage, that the initial cash flow is negative, and that must mean that the futures price will be less than this term or less than the forward price. This derivation of the futures price is complicated and there's not much value to learn that by heart. So I would never ask you to actually reproduce that, and definitely not for an exam. What does this mean? It basically means that you don't really have to learn every single step in that derivation of the futures price. But what I would like you to take away is that the futures price is equal to the forward price if either the interest rate is constant during the lifetime of the futures contract, or the interest rate is randomly changing but uncorrelated to changes in futures prices. The second thing which I want you to remember is that if there is a positive correlation between the interest rate and futures prices, then the futures price is higher than the forward price. And if there's a negative correlation, then the futures price is less than the forward price. Next, I want to talk a little bit about the organization of futures markets and who is trading them. Futures are traded on an exchange. That means that the exchange actually specifies what contracts are traded. And as a trader, you just enter the exchange and then you can submit bids of what long or short positions you want to enter and at what futures prices. And then the exchange compiles all these bids of all the long and short positions at all the different types of futures prices, and uses an auction mechanism to then figure out at which futures price new long and short positions will be open. Closing out before maturity is quite common. That means that if you have a long position and you hold that futures, then many times traders will actually not wait until to the maturity date, but they will enter another offsetting short positions before the maturity. And then the exchange sees that this one trader has both a long and a short position. And then the exchange says, well, this particular trader can basically have himself as a counterparty. And therefore, what they will do is they just cancel out both long and short positions. As we have mentioned before, marking to market or daily settlement is an important part of futures contracts. And the idea of this is that there's never a very big liability accumulated, and therefore it minimizes default risk. On top of this marking to market, we also have margin requirements, which means that when you open a long or a short position, then the exchange asks you to put down some collateral. So they ask you to deposit some cash in an account with the exchange. And that cash will be used to make these daily payments. And as soon as that cash amount in your account drops below a certain level, then the exchange will call you and say, you have to deposit more cash, otherwise we're going to close out your positions. So thanks to the marking to market and the margin requirements, the exchange guarantees that there will be no default of counterparties. So let's suppose you have a long position, and then suppose that the price of the underlying starts to increase more and more, and futures prices start to increase more and more. This would imply that the short position will have to pay money to you. So how does the exchange now handle this? The exchange will then directly take money from the margin account of the short position and deposit it on your margin account. And as soon as the short position runs out of money, if he will not deposit more money in the margin account, then the exchange will say, we will close out your short position, and they will just open a new short position for the next highest bid in the market for opening a short position. So that basically ensures that there will be always a new position available as a counterparty for you. Notice that liquidity can actually be a problem in futures markets because you have to actually make these daily settlements and you have to put down collateral requirements. So let's suppose you're running some strategy for several months where you try to hedge a risk. And the risk on your balance sheet doesn't actually imply any cash flows until to the maturity date. But now if you use for hedging these futures contracts, then you have to pay on a daily basis these settlements. And if the price moves against you in the futures position temporarily, even though it will be eventually offset by your position on the balance sheet, then there can be some cash flow problem. And our case on Metallgesellschaft talks much more about this issue. The final point is, because futures are traded on an exchange, it is actually easy for regulators to have some oversight because they know exactly who is trading on the exchange and what is traded there. And therefore, regulation is easier to enforce than for over-the-counter traded forward contracts. Here is a diagram showing how the organization of futures markets may look like. So you have the exchange here in the middle, and the clearinghouse is the one which organizes the exchange. And so you have many different traders which submit bids to open new long and short positions at various different futures prices. And so these traders which are allowed to submit bids, they need to have a seat on the exchange. And so these are clearinghouse members. And some brokers are directly clearinghouse members themselves. And so as an investor, you can go to the broker, you can say, I would like to open a long position at a certain futures price, and the broker then submits that bid. And in other cases, maybe as an investor, you go to your broker and the broker doesn't have a seat on the exchange directly. So he then goes to the clearinghouse member who then submits the bid for you. Now imagine that this one investor submits a bid to open a long position at a certain futures price, so that will be sent to the exchange. And then another investor down here submits a bid for a short position at the same futures price. That goes through the broker, then the clearinghouse member, and also goes to the exchange. And so the exchange may get many of these different bids. And if they see a compatible bid of both long and short position to trade at the same futures price, then they match them together, and then the long and short positions will be opened. As I've mentioned before, the exchange actually specifies what is traded. And so that means the exchange says what type of underlying securities are actually traded in these futures markets, what is the size of each contract, so how many units of the underlyings are traded per contract. Then they also set some limits to the price and the positions which a trader can take. And they will also specify the delivery arrangements if someone holds the contract until to maturity. And in particular, that involves whether there is actual delivery of the underlying asset or whether there is cash settlement, where again, cash settlement means that you would just look at what is the actual value of the underlying at that maturity date and then compare it to the futures price and just pay the difference in cash between long and short positions. While if there is actual delivery, then the exchange would say which locations actually qualify to deliver and which times during the month can delivery actually be done. If there is actual delivery, then the short position gets to decide out of the possible locations and times which specific location and time she wants to choose. Let me talk a little bit more about credit risk or this default risk and compare forwards versus futures. So for forward contracts, we know that at origination, so at that initial point where you enter the contract, then you set the forward price exactly such that they are worthless. So the present value of the future payments to either long or short position are exactly zero. So that means at the initial point of time, well, there's no liability to either long or short position, and so there's no default risk. Now, after the origination, then prices start to move, and then there might be some positive or negative value to you as a trader. So let's suppose that the price of the underlying starts to increase a lot. That means that the long position now actually has a positive value in the forward contract, while the short position has a liability. And that means that the long position will expect to receive some money in the future, while the short position expects that they have to pay some money. So if there are no collateral requirements, then the long position may now be worried that the short position will not be able to make that payment in the future, or may not be able to deliver that underlying asset at the relatively low price. And so this default risk may actually be an issue, and traders might be worried about it. And one way to get rid of that default risk is to require some collateral as soon as a liability starts to grow. So again, in this example, if the price of underlying starts to increase, then the contract could specify that at that point in time, the short position has to deposit some cash in an account, which will ensure that they will not default at the maturity date. One problem of collateral requirements, however, is that it ties up cash, so it may cause some liquidity problems for these counterparties which have to post the collateral. And these kind of cash flow problems then can push some trader into financial distress. And so, for example, that was a big issue for Lehman Brothers when they went bankrupt, and also for long-term capital management. In contrast, futures contracts have really no default risk, and this is guaranteed by the exchange. Again, the idea was because of marking to market, the value of a futures position is always reset to zero. Therefore, a liability can never really grow very big. In addition to that, the exchange requires both long and short positions to always have some collateral in a margin account, and that collateral will be high enough to ensure that at least the daily payoffs will be satisfied. Let me talk a little bit about the terminology for the daily settlement. Margin, we refer to some cash or maybe also some securities which are very liquid, which means they are very easy to sell again and they have a stable value. So for example, holding treasury bonds. And again, this margin is a collateral which an investor deposits with an exchange. The initial margin, that's the amount which you have to deposit at the very beginning when you first enter a futures contract. Marking to market means that you have these daily payoffs between long and short positions, and that means that your margin account either gets new cash inflow or the exchange will take some money out of your account, depending on whether you gain or lose on the particular day. Maintenance margin, that's the minimum threshold. As soon as your cash amount in the margin account drops below that maintenance margin, then the exchange is going to ask you to deposit more money in your account, and that's also what we call a margin call. The variation margin, that's the initial amount which you have to deposit once your deposited amount drops below the maintenance margin, such that you are again in good standing and the exchange is not closing your position. The exchange sets minimum levels for the initial and the maintenance margin, and they will choose it in a way so that they can ensure that daily payoffs can be satisfied and there will be no default. Brokers may require additional amount of money than the minimums which are set by the exchange, and that really depends just on the broker of how risky he thinks that you are as a client. From a broker's perspective, margin requirements may also depend on what the trading strategy is of the investor. If the broker sees that an investor actually uses a futures position to hedge some other risk in the portfolio, then they will set a very low margin requirement. But if a broker sees that you're speculating, then he may ask for additional collateral. Let me go to an example. Suppose that an investor enters a long position in 2 futures contracts written on gold, and the initial date is June 16th and the maturity date is in December. One contract size is 100 ounces of gold. The futures price today is $1,632.50 per ounce. And the initial margin requirement is $4,500 per contract. So meaning if you enter 2 contracts, you will have to deposit $9,000 in total. And let's suppose that that threshold value, that maintenance margin is $3,333 per contract, or for your entire position of 2 contracts, it's $6,666. So if you now look at the daily cash flows, initially you have entered the contract at $1,632.50 per ounce of gold. Now let's suppose that the market closes a little bit higher with a futures price of $1,655. That means that within that first day since you enter the position and until to the end of the day, you earn a difference of $22.5 per ounce of gold. And since you have 200 ounces, that's $4,500 daily payoff. Since the price increases as a long position, you receive that amount of money. That means your margin account balance now grows from $9,000 to $13,500. On the next day, the futures price increases even more by another $7 per ounce. That means that $7 times 200 ounces, that's $1,400. And that means now your cumulative gain would be $5,900. So that's the 1,400 plus the 4,500. And again, that additional 1,400 is deposited in your margin account. That means you have now $14,900 in your account. On the third day, we assume that the futures price decreases, and in particular, it drops $37 per ounce of gold. Multiply that by 200. That means a loss of $7,400. So what does this mean? The exchange will now deduct $7,400 from your margin account and then deposit that on an account of a short position. And so if you then look at the cumulative payoff, these 5,900, which you have earned since the beginning, minus the 7,400, that means now since the beginning, you have lost $1,500. And your margin account now is only $7,500. Then let's consider another drop by another $2. That means you lose another $400 and your margin account drops even further to $7,100. Now we consider one more drop by another $8, which means you lose $1,600. And now your margin account drops below the maintenance margin. Your margin account is only $5,500, while the maintenance margin was $6,666. Now at that point, the exchange will tell you, you have to deposit more money, otherwise we are going to close your position. And what would that mean if they close your position? They basically are just going to close your long position and open a new long position at the next bid, which is in the market. And that means eventually you lose an additional amount, which is the current futures price versus the futures price of the next investor who will open a long position. So at this point in time, you will deposit another $3,500. That's this margin call to go back to the initial margin of $9,000. And then you can continue going like that to see what these potential changes in the futures prices have implications on your payoffs and your margin account. When we look at quotes in futures markets, there are a few different important things to look at. The first one is the settlement price. That's the price which is used to calculate the daily payoffs, and that's the last traded futures price on a particular day. So that's the prices which we list over here in that example. Then we have open interest. Open interest tells you how many open long positions or how many open short positions we have in the market on any specific day. Notice that number of long and number of short positions always have to be the same because there always has to be an offsetting counterparty. Typically, we observe in markets that there's not a lot of open interest, so meaning there are not a lot of long or short positions open if the maturity is very far in the future. Typically, we see quite a lot of open interest if you have a few weeks to maybe a couple of months left to maturity. Moreover, we see that open interest becomes very small as you get very close to the maturity date, and that's especially true for contracts which have physical delivery of the underlying asset at maturity, and most traders don't actually want to physically deliver. The last thing is trading volume, and trading volume measures how many positions are opened and closed during a specific day. So this is different than open interest, which measures how many positions are open at the end of the day. Trading volume is more about turnover. If trading volume is much larger than open interest, that indicates that traders will open, let's say, long or short positions during a day and close it before the end of the day. Here I have a picture of a quote of futures prices, and this looks more like a quote in a newspaper. But nowadays, if you go online and you look at futures contracts, let's say, for example, on the Chicago Mercantile Exchange, then this looks actually quite similar, or at least you find the same type of variables. So if you look, for example, here at underlying assets, here we have copper, then we have gold and platinum. If you focus on copper, we specify here how many units of copper are actually traded per contract. So in this case, it's 25,000 pounds of copper. And then the prices which are listed are always in cents per pound. So that means for the entire contract size, you would have to multiply the listed prices by 25,000 to figure out what is the actual price per contract. Then we list here the different maturity dates for the future contracts. So we have contracts which expire both in January and some which expire in March. If you look at the contracts which expire in March, then we have here many different price quotes. One is the open price. So that's just the first futures price which was traded on a specific day. Then we have the high and low price. That's the highest and the lowest trading price during a specific day. And then we have the settlement price over here. That's the last traded price before the market closes on the day. And this settlement price, that's important to actually figure out what is your daily payoff. Then we have the change in the price. That's the change in the settlement price from the previous day to today's settlement price. And the minus 0.7 means that if you're a long position in one futures contract with expiration in March, then you have to pay 25,000 times 0.7 cents, or that's $175 on this particular day to the short position. Or in other words, the exchange will deduct $175 from your margin account. Then finally, we see over here the open interest for the March contracts we have on this particular day. 48,809 contracts open. Notice that this is much larger than the open interest for the January contracts. That would suggest that we are probably right now very close to the maturity date in January. And so most people have already closed these positions and have opened positions with expiration 2 months later. We have many different regulators in futures markets in the United States. We have the Commodity Futures and Trading Commission. We have talked about this regulator a little bit in our first case study on the LIBOR scandal and Barclays. Then we also have other regulators in the US. So we would have the National Futures Association. We have the SEC, that's the Security Exchange Commission, the FINRA, the Financial Industry Regulatory Authority, and we have the Fed, or Federal Reserve Board, and the US Treasury Department. All of them in one or another way are involved into regulation. In Hong Kong, we have the SFC, that's the Security and Futures Commission, and then we also have the Hong Kong Monetary Authority, which is the central bank. In China, we have the CSRC, that's the China Security Regulatory Commission. And we have also the central bank in China, which is the People's Bank of China, or also known as PBC or PBOC. The main mandate of regulators is to ensure stability in financial markets and to protect consumers and the public interest. And this in particular also involves fighting financial crime. One example of what the regulator wants to avoid is cornering the market. That is, if you have a very big trader who has market power to actually move or manipulate the price, then the regulator would like to avoid such scenarios. A second problem could be, for example, front running. That's if you have a broker and let's say you submit a big buy order for a certain asset, then that broker may have the temptation to buy some of that assets first by himself. And so after you set that very big buy order, then maybe prices will increase a little bit, and then the broker can sell at a higher price and make a profit. And that's kind of similar to insider information, and that's what the regulator would like to avoid. So since the global financial crisis in 2007, 8, and 9, we actually had a lot of new regulations which wanted to make the financial system more stable. And so these are, for example, the Dodd-Frank Act and the Consumer Protection Act. And there were new capital requirements introduced into banks. And these capital requirements are also part of the Basel norms. One, for us, interesting rule is the Volcker rule, which restricts proprietary trading in derivative markets. So the idea is that you want to avoid that financial institutions, or in particular banks, speculate in derivative markets. So the Volcker rule would say that banks should only trade in derivative markets if they use it for a purpose of hedging. Next, I want to talk a little bit about regulation, why it makes sense from an economic point of view to, for example, have higher capital requirements for banks. To start the discussion, I would like to use a funny picture to illustrate the behavior of investors. And I actually got this picture from a public lecture by Robert Engel, a Nobel Prize laureate in economics. So this picture of this monkey which tries to catch flies flying above the treetops is really a good picture to illustrate the behavior of investors in financial markets. So if you think about this monkey, he knows that if he climbs very high up in the tree, then there are a lot of flies up there which he can very easily catch, and he gets a very nice snack to eat. But the monkey also understands that the further he climbs out on that tree, the thinner the branches get, and the higher is the risk that one of these branches may break and he may drop and get hurt. So therefore, this is a very nice illustration of exactly the trade-off of investors. The more risk you take, the higher is your expected return. Now the question is, what kind of picture would you use for a big bank in the economy? Well, it turns out you can use the same picture of the monkey. Again, the bank wants to earn some expected return and is willing to take certain risks. And it's again this monkey which would say, if I don't climb on the tree, then it's very hard to find insects on the floor. But if I climb very high up on that tree, I know that there are a lot of flies and I can get a very big reward. Now, what's the difference between the monkey picture when we illustrate the bank versus the monkey picture if we illustrate a small investor like you and me? Let's suppose that that monkey was one of the very few, or maybe even the only male monkey in his entire monkey society. Well then, if this male monkey drops from the tree and gets hurt and maybe even dies, then the entire monkey community is doomed. This is similar to a big bank. If a big bank fails, then this link between depositors who save money and give money to the bank and the real economy, which borrows money from the bank to actually realize productive projects, that link will be broken if the bank is in financial distress or goes bankrupt. So then what do you do as a regulator? So let's go back to the monkey society. Let's say that there are a lot of female monkeys and there's unfortunately only this one male monkey. And the females know that this male monkey really likes to eat these flies and he will climb up very high on the tree and take a lot of risks. Again, the male monkey, if he does this decision, he just considers the risk for himself. He says, well, I get these delicious flies, but yes, I know I have that chance to actually get hurt or even die. But again, to him, it still makes sense to go up there because he really likes these flies a lot. What he does not take into account is that the entire monkey society is doomed if he actually dies. So he doesn't take into account that the risk which he's taking has actually much larger costs than just his own pain after dropping from the tree. Now, what do the female monkeys do in this case? How can they regulate the male monkey? So there are a few different things which they can consider. First, they could say, well, let's just put a leash around that male monkey's neck and just bind him to the tree so that he cannot climb up. But that doesn't seem to be a very efficient regulation because then the female monkeys just have to work harder to feed the male monkey, because then he cannot actually find food by himself. So similar if the regulator in the financial industry says we don't allow banks to take any risks at all, well, then you tie the hands of these banks too much, and basically then the society has to support the banks so that they can actually function. So that doesn't seem to be very efficient. Another approach would be that the female monkeys say, well, whenever the male monkey climbs onto the tree, then they take a big net and stand below the tree, and if the male monkey falls down from the tree, then they catch him with the net and he will not get hurt. But that's also inefficient to some extent, because you need a lot of female monkeys to spend time to make sure that that male monkey doesn't get hurt. And in addition, you actually give incentives to the male monkey to take even more risks, because now he knows that if I climb even higher up the tree, then I can catch even more flies. And if I drop, well, then actually nothing happens to me because the female monkeys will catch me. And similar with the banks, if we tell them, for sure, we're going to bail you guys out, don't worry, we're going to buy up all your bad assets and we're going to lend you more money so that you will definitely not fail, then this is a costly policy, because first of all, you need a lot of tax money to save these banks. And second of all, you give bad incentives to these banks that they actually take more risks now because they know in case they fail, they will actually be saved. So what you have to do as a regulator, you have to find somehow a policy which trades off the benefits and costs of this regulation and finds kind of a good middle way so that you can incentivize the banks or restrict the banks from taking too much risks, so that eventually the amount of risks they take, after taking into account the cost for the entire society, will then exactly balance with the expected reward which they can get from the risk taking. Let's go very quickly through some more general discussion on regulation. So the basic argument which you learn as an economist is the argument by Adam Smith. And basically Adam Smith says, if you have free markets, then you get an efficient allocation. So if you just know about Adam Smith's basic theory, then you would ask, so why do we then ever need regulation, since the free market actually does a good job? Well, it turns out that this argument by Adam Smith is limited to markets where you don't have any externalities. And so Leon Walras was an economist who formalized that, and he showed that if there are market failures like externalities or market power, then free markets are not efficient and regulation is needed to get an efficient outcome. So let me just give you a few examples. So if there is, for example, only one company which produces a certain good, then that company as a monopolist has incentives to sell less of that good than what is efficient for the entire society and sell it at a higher price. And so in this case, there is a deadweight loss in this market, and you would want to regulate this market by imposing a maximum price which can be charged for a certain good, and therefore the producer then will sell at that lower price more goods and restoring efficiency in the market. Other market failures might be transaction costs. If it is costly to actually trade with each other, well, then there is less trade. And so in that case, there might be some efficient regulation which helps to reduce transaction costs or give additional incentives to trade, to restore again the efficient amount of trading. And then we also have examples of positive externalities which can lead to too few consumption of a good. And positive externalities are associated with public goods. For example, you can think of fireworks. If I buy fireworks because I like to watch them, then for me the trade-off of how much it costs to buy a firework and how much happiness I get from it maybe will lead me to just buy a little bit of fireworks. But now my neighbors can actually also watch and enjoy that firework for free. So there's this kind of free rider problem. But what would be much more efficient, since many people of us can enjoy the firework together, is that everyone will chip in some amount of money so that we can buy a lot more firework together and get much more happiness overall. So here, if everyone by himself will decide how much firework to buy, then everyone will buy just very little, because again, he wants to actually free ride from all the other people who buy and use the firework. And an efficient regulation would be if the government decides that they will impose a tax on everyone, and then the government will buy the efficient amount of firework, which will maximize overall happiness in the society. On the other side, we have negative externalities. This could be an example of a factory which produces something, but with the production, they also have some pollution. So for example, if you use coal to produce electricity, well, then the coal which you burn, that will actually pollute the air, and that's going to affect the health of people living around that coal power plant. And now for the coal power plant, they'd only take into account how much it actually costs to buy coal and operate the plant, and how this trades off with the amount of money which they can earn from selling the electricity. But what they do not take into account is the cost which they impose on all the neighbors who get affected by the pollution. So that means that that coal power plant will produce too much electricity because their personal costs are much lower than the overall cost for society. Then a regulator should impose a certain tax on that coal power plant, and that tax should reflect that cost which the power plant imposes on the society, such that eventually when the coal power plant now takes into account not just its own production cost, but also that additional tax, which again is equivalent to the cost imposed on the society, now they will choose the efficient amount of electricity which they produce. And moreover, the government can then use that collected tax to do something good to the society, to compensate them for the damage which they experience through that pollution. And finally, if you think about the banking industry, again going back to that example with the monkey, banks, they don't take into account the cost which they impose on the entire economy if they are in financial distress or in bankruptcy. So that cost, when that link between depositors and real entrepreneurs in the economy is broken, and therefore it is efficient to restrict risk-taking of these banks to restore an efficient amount of risk-taking. For the remainder of this chapter, I want to talk about hedging risks using futures, and some of these arguments also can be applied to forward contracts. Hedging or managing risks using futures contract means that you take a position in the futures market which exactly offsets a position on the balance sheet, and therefore overall is going to decrease the risk which you are exposed to. The purpose, therefore, is to lock in a price at which you can buy or sell an asset at a future date, and therefore you don't have any exposure anymore to the fluctuation in the price of that asset. We have two different kinds of hedges. One is called the short hedge, and the short hedge involves a short position in a futures contract. And this is appropriate if a hedger expects to sell an asset at some point in the future. So meaning with the short position, you can lock in the price at which you sell that asset. Or in other words, if the hedger has a long position in the underlying asset, then a short hedge or the short position in the futures contract will protect this hedger against an unexpected drop in the spot price. And then on the other side, we have a long hedge, which involves a long position in the futures contract. Here you agree to buy the underlying at the maturity. That's appropriate when you expect that you have to purchase something at a future point and you want to protect yourself from an unexpected increase in the spot price, which would then make more expensive for you to buy that underlying asset if you did not use the futures for hedging. Let me just go very quickly through some examples and ask whether we need a long or a short hedge. Let's say we are a firm, we expect to produce and sell 90,000 pounds of copper in 5 months. So here we are actually holding a long position. So we have that copper and we want to sell it in the market, and therefore we will use a short position in the futures contract to hedge the risk that the price of the underlying may drop and we don't get as much money from selling that 90,000 pounds of copper in the future. So with the short position in the futures, we actually get some payoff if the price drops. So in this case, we use a short hedge. The second example, we take the perspective of an exporter who cares about US dollars, and he exports something to Switzerland and knows that he will receive payment in Swiss francs in 3 months. And futures are quoted as US dollars, which you pay per Swiss franc. In this case, since you know you will have Swiss francs, it means that you have a long position exposure to the Swiss franc. So a devaluation in the Swiss franc would be bad news for you, because then the Swiss franc which you receive is worth less in US dollars. And therefore you want to protect yourself against a drop in the Swiss franc. And that means you take a short position in the futures contract where you lock in the amount of US dollars which you get per Swiss franc. So this means we have again a short hedge. Then the final example is a copper fabricator who knows that it will require 100,000 pounds of copper in 6 months to produce something. This means that the risk to this fabricator is an increase in the copper price, because then the fabricator will have to pay more money to buy that copper. So that means right now it holds a short position in copper, and therefore it is a good thing to take a long position in the futures market, which will have a positive payoff if the copper price increases, and therefore offsets the higher amount which the fabricator has to pay to buy the copper. Or in other words, it locks in the price at which fabricator can purchase that copper. So here we have a long hedge. So let's talk a little bit about why firms want to hedge risk. And the first argument is that the firm wants to focus on its key skills. And therefore, the firm would like to minimize the risks which are not in its control. So for example, if you're producing something, you want to focus on your skill to actually provide a very good quality product to customers. But it's, for example, not under your control how high interest rates are, which you have to pay for some loans to finance your business. Or it is not under your control what the exchange rates are if you're selling or buying things in a foreign market, or similar with other market variables which you might be exposed to. Hedging can also be optimal when an extra dollar of income is worth less to you during times of very high profits, but it would be more valuable to you during times where you have very little income. And there are many motivations for that. A very simple would be progressive taxes. So if you have a lot of income, then an additional dollar is taxed at a higher rate. If you have very little income, then an additional dollar is taxed at a very low rate. Here I would like to have a hedging position which earns me more money during bad times, and I lose some money during good times. So shifting profits from times of high income to low income, that seems efficient from a tax point of view. More important are probably bankruptcy and distress costs, and that's also related to costly external financing. So suppose you're a company, and so during good times, it's very easy for you to raise new capital. But during bad times, if you're very close to bankruptcy or if you are in distress, then raising more capital might be difficult, because investors don't really want to give you money if they know that you are in trouble. And so then during these bad times, if there are some very good projects coming along, you may not be able to actually undertake this project because you don't have the money to do that. Then hedging would be very efficient, because if you could get a payoff in derivative markets during the bad time where you're close to bankruptcy and distress, and you can give up some money during good times where you have plenty of cash or access to external financing, will definitely be an efficient thing for your company. The last point is about the risk aversion of a manager. So if the manager's salary is actually tied to the performance of a company, and the manager wants to avoid to ever get very low salary, then he maybe wants to also reduce risks in the profits and therefore would like to hedge risks. Moreover, if investors actually want to reduce risk, then it may be more efficient for a firm to hedge risks than for an investor to try to hedge risks by themselves, because hedging might be much less costly for a firm than for a stockholder herself. First of all, firms may have access to more derivatives than small stockholders, so it might be less costly from this point of view. And firms probably also have better information about the risk which they are exposed to, and therefore it should be more efficient for them to find derivatives which can specifically get rid of the risks on their balance sheet. There are also some reasons against hedging. So first of all, shareholders may say, well, I don't really care if the firm is exposed to some market risk, because at the end of the day, these risks will translate in some volatility in the stock prices, and then the shareholder can either hedge that risk using derivative contracts, or diversify these risks by investing in many other stocks or bonds. Another argument is that any type of hedging involves some transaction costs. That might be brokerage fees or bid-ask spreads to trade derivatives in markets, or it might be also just costly expertise to hire people who actually know how to hedge these risks, and we have to pay them a high salary. Moreover, hedging needs a lot of attention, so you need to monitor the process, and you may actually also need to monitor the traders who help you to hedge the risks. Remember again from the first lecture where we talked about these traders who were supposed to hedge risks or implement arbitrage strategies and eventually got bored and started to speculate. So you definitely don't want that to happen in your company. In addition, there might be cash flow or liquidity problems. So that might be if the payoffs of the hedging position are realized at a very different time than the gain or losses on the balance sheet. And this can lead to some very serious problems and forcing maybe a company to exit a hedging position too early and realize some very large losses. And one example is the case study on Metallgesellschaft, where we dig much deeper into that issue. Another type of cost of hedging is potential requirement for collateral, so it will tie up some cash of the company which they can then not use for some other business activity. Moreover, there might be some complications how taxes have to be paid on the hedging positions versus the gain and losses on the balance sheet, and this also can complicate accounting and the communication with investors. Finally, it can be difficult to explain losses in the hedging position, even if they're offset by big gains on the balance sheet, because many times investors or the public, they don't understand that ex ante hedging reduces risks. Many times they just focus on exposed outcomes, and if they see some losses in a hedging position, investors or the public may be very quick to draw the conclusion that the Treasury Department of that corporation was just doing something bad. In the data, we observed that not only financial, but also many non-financial firms use a lot of derivatives, and we see statistical correlations that large firms use more derivatives than small firms. Firms with more investment opportunities use more derivatives than firms with less investment opportunities. Firms with a higher market value use more derivatives than firms with lower market value, and firms with a higher leverage use more derivatives than firms with a lower leverage. Now, all of these statistical correlations don't really tell us anything about the causation. So it could be that large firms use more derivatives just because they have the expertise and also the resources to do efficient hedging. But it also could be that maybe firms become very large because they're more successful because they use derivatives to hedge risks which are not in their core business. At the end of the day, we don't know in which direction the causation goes. We only can tell that there is this correlation. Finally, I want to talk about imperfect hedging. So in the previous examples, we always figured out a situation where you can perfectly get rid of risks on your balance sheet. So for example, a corporation which does business abroad and knows that they receive a foreign currency in the future, they were able to exactly use a short position in a forward exchange rate contract to offset all the risk and lock in the exact dollar amount which they receive for exchanging that foreign currency income. However, in reality, many times hedging positions are not perfect and there will be always some residual risk. This imperfection can come from two different sources. One could be a mismatch of the asset which you're trying to hedge and the futures contract which you're using for hedging. So for example, if I want to hedge the risk in jet fuel prices as an airline, then there might be no futures contract written on jet fuel. So I would use futures contract written on crude oil to hedge that risk, because I know that crude oil prices and jet fuel prices are very highly correlated, but this hedge is not going to be perfect. The second reason would be a maturity mismatch. So let's suppose I want to hedge a risk until the end of October, but I only have a futures contract which expires in mid-November. So therefore, the time until when I want to hedge the risk is not exactly the same as the maturity date when the futures contract expires. These type of imperfections will introduce basis risks. The basis is defined as the difference between the price of the asset which you try to hedge and the futures price which you use for hedging. And this can also be decomposed into the two dimensions of imperfection. Let's introduce S star as the price of the underlying asset of the futures contract. And then we can introduce in this equality plus S star and minus S star. And then what we can look at is the difference between S and S star. And that would measure the mismatch between the asset which we are trying to hedge and the underlying asset of the futures contract which I use for hedging. So that would be that example of jet fuel prices versus the crude oil prices. And then the second difference would be about the maturity mismatch. So here I would say I only want to hedge, for example, until time small t. And so I look at what is the price of the underlying asset at time small t. And then I look at the futures price at small t, which is then not perfectly converging to the price of the underlying asset. It would only converge at the maturity date, capital T. So let me move to the virtual whiteboard to illustrate that concept of basis a little bit more. So let's suppose you want to hedge a position on your balance sheet from time t1 to time t2, but you only have a futures contract which expires at time capital T, which is more in the future. Now let's suppose you want to buy some asset at time t2, and therefore you want to use a long position in the futures contract for hedging that risk, or in other words, you use a long hedge. And the futures price today is F with maturity at time capital T, locked in at time small t1. So to enter the long position today, I have a zero cash flow at time t1. And then let's suppose you keep that long position in the futures until time t2, and then you enter an offsetting short position to close out your position at time t2. That means your payoff is going to depend on the futures price at time t2 with maturity time capital T. And if we ignore reinvestment of the daily payoffs, then our cumulative payoff will be the futures price at time t2 minus the futures price at time t1. So therefore, what does this mean? So if you have to pay ST2, but through the long position we get this payoff over here, then our total cash flow is, or I can rewrite this as where the first term captures the futures price which I try to lock in, at which I can buy the underlying asset. And the second term over here, that's just the basis at time t2. So this is an example of purchasing an asset at time t2. Let's look at another example where we try to hedge if we want to sell an asset at the future date t2. Selling the asset means that you will receive the price as T2 for that asset at time T2. And in this case, we take a short hedge, which means we take a short position in the futures contract where we try to lock in the price in the future at which we can sell that underlying asset. So again, we start with a futures price at time T1 with a maturity date at time capital T. And we take a short position today in that futures contract, which has a zero cash flow today. And then at time t2, I will close out my short position by entering an equivalent long position, which then means my payoff will be the difference between the futures price at time t1 minus the futures price at time t2 with maturity at time capital T. And this payoff again assumes that we ignore reinvestment of the daily cash flows. So we just simply add up all the daily cash flows between t1 and t2. And so if you sell the underlying asset at price ST2 plus now the payoff from your short futures position, this adds up to, which can be rewritten as, where the first term over here represents that futures price which you try to lock in at which you want to sell the underlying asset. And the second term is the basis at time t2. So we see that in both examples of selling an asset or purchasing an asset, one time we try to lock in the price at which we buy the underlying asset, which is given by that futures price at that initial date T1. But then on top of that, we actually have to pay the basis at time T2, where that basis may be a positive amount. So then I have to pay a little bit more than the futures price which I tried to lock in, or it could be a negative amount, and then I have to pay a little bit less than the futures price which I tried to lock in. But the idea is that this basis is relatively small because the price of the underlying and the futures price over here are highly correlated. Similar in the case of selling an asset, I try to lock in the price at which I can sell that asset, given by that futures price back at time t1. But on top of that now, I may have either a positive or negative basis, and that will distort a little bit that selling price. So I may get a little bit more or a little bit less. But the risk of this is hopefully limited because, again, I want to choose a futures contract which has a futures price which is very highly correlated to the price of the asset which I'm actually trying to sell. This volatility in the basis is going to be higher if the maturity mismatch, so the difference between time t2 and capital T, is larger, because then the futures price may be less moving together with the price of the underlying asset, because there's also interest rate risks, there are storage cost or dividend yield risks and convenience yield risks. And there is more volatility in the basis if the price of the underlying asset on which the futures contract is written is less correlated with the price of the asset which I'm actually trying to hedge. So let's go back to slide 31. Here I just summarize again these cash flows, which I write down also on the virtual whiteboard. So this is the same thing. And then let's talk a little bit now what we learned from this analysis. So what kind of contract should you choose for hedging if you cannot choose exactly a contract which gives you a perfect hedge? Well, first of all, you want to choose a contract which has a maturity date close to the date until when you want to hedge your position. But notice that you actually would like to choose a maturity date which is slightly longer than the date until when you want to hedge, rather than a maturity date which stops early. The reason becomes apparent if you go back to that virtual whiteboard. Let's suppose you stop your hedging position before time t2. So let's suppose at this date over here. But then it means that that full time length between when the maturity date is of that futures until time t2, then we are exposed to full fluctuation in the underlying asset price. In contrast, if you hedge for too long time, so meaning maturity date is later than the date until when we want to hedge, then the risk exposure is actually only due to the volatility of the difference in the price of underlying asset and the futures price. And still these two things are quite highly correlated, even though this maturity date is not the same. So meaning that if I choose a maturity date of the futures later than the date when I actually want to hedge, it's likely to come with a smaller volatility than if I have a full risk exposure if my hedging position stops too early. So the rule of thumb, therefore, is you want to choose futures contracts which expire either exactly at the date when you want to hedge or slightly later. Notice that before we also said that the open interest is actually highest for futures contracts which have a few weeks to just a couple of months left to expiration, but open interest is relatively low for a very long time to maturity. So now if you want to still hedge the risks for a very long time, then an efficient thing to do is trade contracts which have a short term to maturity. But then once you reach the maturity date, then you close out these futures positions and reopen new futures positions, which again have a maturity date a few months later. And so you keep rolling over these contracts until you reach the actual date until when you want to hedge your position. The reason why you want to trade in futures contracts which have more open interest is just simply because there is more liquidity, so there's more trading going on in these contracts, and therefore bid-ask spreads and transaction costs are going to be lower. When you have a mismatch in the underlying asset of the futures versus the asset which you try to hedge, so in other words, when you try to hedge an asset for which you don't have an actual futures or forward written on it, then you try to find a derivative contract which is written on an asset which is very highly correlated with the price of the asset which you try to hedge. That will again reduce the volatility in that basis risk. So going back again to the definition of the basis, if the price of the underlying of the futures which you use is very highly correlated to the price which you try to hedge, well then the volatility of this difference is going to be very close to zero. Let's look at an example of a maturity mismatch. Let's say on the 15th of June, a company expects to purchase 20,000 barrels of crude oil sometimes later in October or in November. So they don't know the exact day, but they know that they will have to buy crude oil at a future date. Now let's say that there are futures contracts traded on crude oil, and each contract is of a size of 1,000 barrels of oil. And let's say you have contracts available with delivery time in every month. Now, if you want to be conservative because you don't know whether you want to hedge your position until early October or until late November, let's suppose you choose a futures contract which has maturity in mid-December. So taking a maturity date slightly longer than until when you actually want to hedge. Now let's suppose that the futures price on June 15th with a maturity in December is $68 per barrel of oil, or meaning for 20 contracts or 20,000 barrels of oil, that would be $1.72 million. Now let's suppose the company takes 20 long positions in this futures contract with maturity in December and tries to lock in the price of $1.72 million, which they have to pay for the 20,000 barrels of oil. And let's suppose now the company decides on November 10th that they actually want to purchase these 20,000 barrels of oil. And now the price of the crude oil in the spot market is $88 per barrel. And the futures price of that contract with expiration in December is $87.10. So notice that the futures price is not the same as the price of the underlying asset in this case, because the futures price still has some time left to maturity, and therefore it has not yet converged to the price of the underlying asset. So what does it mean? If you have 20 long position in the futures contract, then again ignoring daily settlements and reinvestments of the daily payoffs and just adding up all these changes in futures prices between June 15th and November 10th, then as a long position you get a payoff equal to the futures price in November of $87.10 minus the futures price when you entered the long positions in the contract of $86. So that's $1.10 per barrel of oil. Since you have entered 20 futures contracts, which are written on 20,000 barrels of oil, that means 20,000 times that $1.1, or you get a positive payoff of $22,000. On the other side now, you have to pay $88 per barrel of oil to buy that crude oil in the spot market, which means you have to pay $1.76 million. So if you now look at your combined cash flow, you have to pay $1.76 million minus the $22,000. That's $1.738 million. Instead of looking at the cash flow by computing how much money you have to pay in the spot market and then combining this with the payoff in the long futures contract, I could also use my formula from before, where we say that the cash flow, if you want to purchase an asset, is going to be the price which you try to lock in plus the basis. So in our case, the basis is the $88 of the spot price in November minus the $87.10 of the futures price in November. And so that basis is 90 cents per barrel of oil multiplied by the 20,000 barrels of oil. That's $18,000. So then what does our formula say? It says that you try to lock in that futures price back in June, which is $86 per barrel, or this $1.72 million for the 20,000 barrels. And now you add to that the basis of 18,000, that means you have to pay $1.738 million. So again, that's the same cash flow of what I have calculated if I use the spot price which I have to pay and then combining that with the payoff from the 20 long positions in the futures. It doesn't really matter which approach you take. At the end of the day, both ways, you get the result that you pay $1.73 million for the 20,000 barrels of oil. Finally, just to stress this again, so what's the reason why we were not able to lock in exactly the price of $1.72 million to purchase these 20,000 barrels of oil? Well, the reason was because the futures which you use for hedging has an expiration date in December, which is different than the date in November until when you actually hedge, and therefore the futures price has not perfectly converged to the price of the underlying asset yet. It would do so in December at the maturity date, and so we have some risk exposure because the futures price and the price of the underlying were not perfectly correlated, and that risk was reflected by that basis over here. Finally, I want to dig a little bit deeper in this imperfect hedging, and I want to talk about something called cross-hedging, which also tells us what is the optimal number of futures position which you have to take when there is no perfect hedge available. Now I want to move to the virtual whiteboard and first write that down step by step, and then we can come back to the lecture note to show that we have the same thing as what we write on the virtual whiteboard. So let me start by plotting the relationship between changes in futures prices for the futures contract which you use for hedging against the changes in the price of the asset which you try to hedge. And so here the delta indicates that change in the price, and you can think of many different time horizons. Let's, for example, suppose daily changes. And what I want to do is I want to plot for many different days some data which you may observe in the market. Let's say on one particular day, the futures price changes by this much dollars, and at the same day, the price of the asset which you try to hedge changes by this much dollar. So then what I would do is I draw this point over here as one of my observations. Maybe on another day, the futures price increases much more, but the price of the asset which you try to hedge doesn't increase as much, and therefore I would have another data point. Then maybe on another day, the futures price increases just a little bit, and the price of the asset which you try to hedge also just increases a little bit, and I get another data point over here. And so you can get many data points distributed all over the place. The first thing which we want to do is we want to figure out a linear relationship which captures this cloud of points as good as possible. And the way we decide whether it fits this cloud well or not is we look at these deviations between these points from that linear line, and we square all these deviations and then sum them up. And why do we square them? Because sometimes they're positive and sometimes they're negative. So if we would just add them up, then they may be on average 0, but still these observations may deviate a lot from the linear line. So if we square them, then all the negative observations also become positive, and then the sum over it gives us a better measure of how close these points are to the linear line. And the construction of this linear line with the objective to minimize the sum of squared deviations, that's also called a linear regression. The linear regression has two important components. The first one is the constant term, which we denote by K, and which measures by how big is on average delta S if the futures change delta F is equal to 0. And then the second important thing is the slope of this linear line, which we denote by H. Therefore, the change in the price of the asset which we try to hedge can now be written as the constant K plus the slope coefficient H multiplied by the change in the futures price, delta F. And then to account for these deviations of the points from the linear line, we add something called an error term, and we denote that by epsilon. Now, in a linear regression, we choose the linear line such that on average, the error term epsilon is 0. So that means taking the expectation of epsilon is equal to 0. And the correlation between the error term epsilon and the changes in the futures price delta F is also equal to 0. Notice that in this case, where the expectation of epsilon is equal to 0, then the covariation between delta F and epsilon can also be written as the expectation of delta F multiplied by epsilon, and this is equal to 0. Now, once we have this model set up, then what we are interested in is this slope coefficient H, because this thing is going to give us the optimal hedge ratio. And in a linear regression, this slope coefficient H is equal to the covariance between the changes in S and the changes in F divided by the variance of the changes in F. And the covariance can also be written as the correlation between the changes in S and the changes in F times the standard deviation of the changes in S times the standard deviation of the changes in the futures price. And then again, we divide that by the variance of the futures price changes. I have a derivation of this formula on slide 36, but I don't want to go into the details and you don't really need to know that. If you're interested in where it comes from, then you can go through these calculation steps on this slide and eventually you get H is equal to this covariation between delta S and delta F divided by the variance of delta F. Now, why does this slope coefficient H give us the optimal hedge ratio? Well, because H tells us by how much does the price of the asset S change if F changes by $1, plus then some constant and some error which I cannot do anything about. So suppose you take 8 short positions in the futures, then if the futures price increases by $1, the change in the asset price will be K dollars plus H dollars plus some error term epsilon. And my futures position will now lose exactly H dollars. On the other hand, if the change in the futures price is minus $1, so it decreases by $1, then now the change in the asset price S is going to be K dollars minus H dollars plus that error term epsilon. And my futures position earns now exactly plus H dollars. So combining that asset position with H short positions in the futures will exactly offset that variation in the futures price. So let me write that down more formally. If we consider a timeline from time t1 to time t2, and we denote by delta S the change in the price of the asset between time t1 and t2, and by delta F we denote the change in the futures price between t1 and t2, where the futures price has a maturity at time capital T, and time capital T is later than time t2. And if we now consider a position of QS number of units in the asset S, then the change between T1 and T2 will be these QS units which we have in the portfolio times the change in that price, delta S. And we use N short position in futures, and each futures contract is written on QF units of the underlying asset. Then the payoff of these N short positions is going to be minus N times the number of units on which each futures contract is written times the price change in the futures per unit of the underlying asset. And what I do now is I plug in this linear relationship which we had over here for delta S. And so I have now QS, the units of assets which I have in my portfolio, times the constant K plus the slope coefficient H times the change in the futures price plus that error term epsilon. And then again, we have minus the number of short positions in the futures times units per futures contract times the change in the futures price. And the aim is going to be choose the number of N short positions in futures such that we minimize the variation of this overall position. Now, what is this variance? Well, the constant over here doesn't have any variance by definitions as it is a constant. So we do have some variation in delta F. And notice that delta F can be factored out here and here. So we're going to have QS times H minus N times QF. And if we take this out of the variance, then we have to take the square of this multiplied by the variance of the futures price change. And then we have some variation also in that error term epsilon. And so here we have plus QS squared times the variance of that error term. And so again, we want to choose the number of contracts N to minimize this entire thing. Notice, because this term is to the power of 2, the best you can do is reduce that to 0. And so the way you do that is by choosing N being equal to number of units in the asset which you try to hedge times that slope or optimal hedge ratio H divided by number of units per futures contract. Now this will ensure that this term over here is 0 and therefore you have no more exposure to that variation in the futures price. Now notice that using this number of short positions in the futures will help us to get rid of any variation in the futures price delta F, but we cannot do anything about this error term. So this is always some residual risk which we are stuck with, and that is capturing that basis risk. So this basis risk is going to be higher if these deviations of these points from the linear line are larger, and that's the case if the correlation between delta F and delta S is closer to 0. In other words, if we choose a correlation between delta F and delta S close to 1, then these points will be very close to the linear line. And so the variation of this epsilon or this basis risk will be very close to 0. Notice it also would work if the correlation between delta S and delta F is close to -1, then your linear line would be decreasing. But again, the epsilon terms will be very close to that linear line. And again, this variation in epsilon will be close to 0. In that case of a negative correlation between delta F and delta S, instead of taking n short positions, you would want to take n long positions for hedging. So this argument from the virtual whiteboard is also summarized on slides 34, 35, 36, and 37. Ending up again with the number of optimal short positions in the futures contract, which is equal to that slope or this optimal hedge ratio times the number of positions which you try to hedge divided by the units of underlyings per one futures contract. Now notice that this derivation was done for price changes in the asset S and the futures price F between time t and time t2. There are two issues about this. So first of all, with futures contracts, we actually have daily settlement. So you have payoffs in between T1 and T2. And we should not just look at this cumulative change, which is given by delta S and delta F, because we could actually reinvest daily payoffs. And the second thing is if we go to the data to estimate the variation in delta S and delta F, or the covariation between these two things, then if you look over many days, that price change is not a stationary variable and it might be difficult to estimate. So a better way to look at is daily returns. And so instead of trying to minimize the overall price change in my position, I could minimize the daily returns of my position. So what would that look like? So I would define now the daily return in the asset S as the daily price change in asset S divided by the current price on that particular day. And similarly, I define the return in the futures as the daily price change in the futures divided by the current futures price on that particular day. And now what is my daily return? It's going to be the value of my position S on day tau times the return of asset S on that particular day tau, where the value of the positions S on day tau is given by the units of assets which we are holding times the price of the asset at time tau. And now minus the number of short positions which I have on day tau, multiplied by the value of the futures position on day tau, multiplied by the daily return of the futures on day tau, where again now that value of the futures position on day tau is the units of underlying assets in one futures contract times the futures price at day tau. Now similar to before, we can minimize the variance of this entire daily return by choosing the number of futures contracts which we short sell. And similar to before, we write down a linear relationship between the return of asset S on day tau, depending on the futures return, where we say there's some constant level K plus slope coefficient H times the return on the futures price plus an error term epsilon. And so again, if you plug that in, you get minimize the variance of the value of your position S multiplied by the constant K plus the slope H times the return of the futures on day tau plus the error term epsilon minus the number of futures contracts which you short sell times the value of one futures contract on day tau times the return of the futures on day tau. And again, as before, we can write that by factoring out the return on the futures as the value of your position in asset S times the slope H minus number of future contracts which you short sell times the value of the futures on day tau to the power of 2 times the variance of the return in the futures plus the value of your position at day tau to the power of 2 times the variance of that error term epsilon. And again, now the optimal number of short positions which you should take on day tau is going to be equal to the value of the position which you try to hedge times that slope coefficient h divided by the value of one futures position. So this formula looks very similar, just you replace the quantities which you have in your portfolio in one futures contract by the value of your portfolio which you try to hedge and the value of one futures contract. Notice that the H coefficient here is not exactly the same as the H coefficient over here, because here we had a linear relationship between the price changes S and the price changes in the futures F, while here the linear relationship is in terms of the returns. However, if you look at daily price changes versus daily returns, these slope coefficient H are going to be very similar. So except for some small approximation errors, we can basically assume that they are the same. Notice one more important thing, this optimal number of contracts which you short sell depends on the time tau where you are right now, because the value of the position which you try to hedge and the value of one futures position keep changing over time. And so therefore, you should actually on a daily basis readjust the number of short positions which you take in the futures contract for hedging to minimize variation in daily returns. This is in contrast to what we did before, because here we concern about the price change over the entire time period between T1 and T2 and not this daily variation in the returns. And so therefore, we just had this static hedge where just in the beginning you take a number of short positions and you hold on to it until time T2. So here where we are concerned about the daily returns, we actually have to readjust on a daily basis. This is also explained here on slide 38. Finally, on slide 39, I give you some formulas how to estimate the variance and covariation between two random variables. So suppose you have data for variable X, so that might be the daily returns of the asset which you try to hedge. And then let's say we have variable Y, which are the daily returns on the futures contract. Then the expected daily return on X would be just the sum over all daily returns which you have divided by the number of daily observations which you have. And then the variance in these daily returns are just the daily return of each observation, how it deviates from the average return to the power of 2 divided by the number of observations minus 1. Why is there a minus 1 over here? If you take the expectation of this entire thing, then it turns out to be exactly equal to the true variance of these daily returns. But this is only true if you have n minus 1. In other words, this means on average, if you take this formula over here, then you estimate the true variance of these daily returns. For the covariation, what we do is for each observation of the daily return, we look at how much does the asset S daily return deviate from the average daily return, multiplied by how much does the future return on that same day deviate from the average futures return. And then we take the sum over all these daily deviations and divide again by number of days minus 1. For practical purposes, when you work with, for example, a software package like Excel or something like MATLAB and Python, they have typically functions already programmed where you can just provide the daily observations and it already estimates these variances and covariances. And so therefore it makes life a little bit easier. You don't actually have to remember these formulas. Let's look at an example. Let's suppose you are an airline and you know you will have to purchase 2 million gallons of jet fuel in 1 month's time, and you will use heating oil futures to hedge this position. And one heating oil futures contract is written on 42,000 gallons of heating oil. Now, from the historical data, we see that the standard deviation in heating oil futures return is 0.0313, the daily standard deviation in jet fuel prices is 0.0263, and the correlation between daily jet fuel and heating oil futures prices is 92.8%, which is very close to 100%. Now let's suppose that the current spot price of heating oil is $1.94 per barrel, and the futures price with 1 month to maturity is $1.99 per gallon of heating oil. So if you want to purchase 2 million gallons of jet fuel, that means you take these 2 million gallons times $1.94 per gallon, and that gives you a current position value of $3.88 million. Similarly, for the heating oil futures contract, one contract is written on 42,000 gallons of heating oil, and therefore we have to multiply that by $1.99 per gallon, which gives us $83,580 per futures contract. Now, the optimal hedge ratio is given by the correlation between heating oil futures prices and jet fuel prices, which is this 92.8%. multiplied by the ratio of the standard deviations in jet fuel prices and heating oil futures prices. And if you plug in these values, we get an optimal hedge ratio, or the slope coefficient, of 0.7798. So if we were to ignore daily settlements, so looking at this analysis where we look at price changes over an entire month, and assuming again that that slope coefficient is the same as if we look at daily returns, then the number of long positions in the heating oil future should be 0.7798 multiplied by 2 million gallons of jet fuel, which we want to buy, divided by 42,000 gallons of heating oil per futures. That means we take a long position of 37.1 futures contracts. Why is it a long position here? Well, because we have to purchase the gallons of oil. So we are afraid of an increase in the price of jet fuel. And since heating oil futures are positively correlated to jet fuel prices, that means we want to get a positive payoff in the futures if the futures price increases, so we need to take a long position. If we care about the daily settlement, so we use this tailing of the hedge, where we look at the relationship between the daily returns. So we use this formula over here. Now if we plug in into our formula, we have again that slope coefficient of 0.7798, but now we multiply that by the value of the position which we try to hedge, which is this $3.88 million, and we divide by the value of one futures contract, which is the $83,580. And on the initial day, we have to take 36.2 long positions. Note that for that static hedge over here, where we ignore the daily settlement, we just take once that 37.1 long positions in futures contracts, while with the tailing of the hedge, where we on every day minimize the variation of the daily returns. There we take on the first day 36.2 long positions, but then on the next day, this position may change depending on how much the value of our position to hedge and the value of one futures contract will change on the next day. So in this case, we have to recalibrate our hedge on a daily basis. Now we can also apply our hedging concept to hedging stock prices. And here the idea is that typically you want to hedge the entire market risk to which a stock is exposed to. And if you use a futures contract on the entire market, then looking again at this linear relationship over here, we would say, well, the futures just captures that return on the entire market, while here we have the return on the asset which we try to hedge. And then this linear relationship is really nothing else than the CAP-M relationship, where the constant K is now the abnormal return alpha in the CAP-M, and the slope coefficient H would be the risk exposure beta of the asset towards the market, and the error term epsilon is the idiosyncratic risk of the asset which we are considering. So therefore then, if you consider the daily hedging of the market risk of a certain stock or stock portfolio, you take n number of short positions equal to beta of that asset which you try to hedge, multiplied by the value of your portfolio which you try to hedge, divided by the value of one futures contract written on that market portfolio. So let's jump directly to an example. Let's say you manage a well-diversified portfolio of stocks. Well-diversified means that all the idiosyncratic risk is washed out and you're only left with systematic risk. And in other words, in our linear regression, that means that this error term is always equal to 0, or all these points lie exactly on the linear line. Now let's suppose that we take the S&P 500 index as the market portfolio. So we consider then futures written on that S&P 500 index. And we suppose that the CAPM relationship holds, where we relate stock returns to that S&P 500 return as a proxy for the market return. Let's suppose that the S&P 500 index has today 1,000 index points. Notice that an index is not measured in a dollar value, but in index points. And then the futures contract, which we use for hedging, has 4 months left to maturity, and it is written on the S&P 500. And the futures price today is 990.05 index points. Now suppose that one futures contract is written on $250 per futures index point, and that means since the futures price today is 990.05 index points, then the value of one futures contract is 250 times the 990.05, or about $250,000. What does it mean that the futures is defined as $250 per index point? It means that if the futures price increases by 1 index point, then the long position earns $250. If the futures price decreases by 1 index point, then the long position loses $250. Suppose also that the value of our portfolio today is $5 million and the risk-free interest rate is constant over time and equal to 1%. The dividend yield on the S&P 500 is assumed to be equal to 4% per year. And the CAPM beta, so that risk exposure of our portfolio, is 1.5. We next want to assume that we use the 4-month future contracts on the S&P 500 index to hedge our risk for just the next 3 months. So there's a maturity mismatch in that hedging strategy. If there was no maturity mismatch, then our hedge actually would be perfect because we assume that there's no idiosyncratic risk. So we have this well-diversified portfolio. And in other words, the S&P 500 index actually moves 1-to-1 with that well-diversified portfolio. And therefore, if there was no maturity mismatch, then you could perfectly hedge all the risks in that stock portfolio. However, because we have the maturity mismatch, we hedge a position over 3 months with a futures which have an expiration in 4 months. Therefore, our hedge is going to be imperfect and there is going to be some basis risk. Before we figure out how many long or short positions we have to take in the index futures, I just want to derive very quickly again, how do we actually get to the futures price of 990.05 index points? We know from our no arbitrage relationship that the futures price has to be equal to the price of the underlying asset, discounted by the dividend yield multiplied by the gross return of the risk-free asset. So the futures price with maturity in 4 months is equal to the 1,000 index points of the S&P 500 at time 0 times e to the power of the interest rate of 1% minus the dividend yield of 4% multiplied by 4 months. And this yields 990.05. So next, let's draw a timeline where we start at time 0. Then we want to hedge until time 3 months. And then we use a futures which expires in 4 months. Now the first question is going to be how many long or short positions are we going to take in the futures contract to hedge as much risk as possible. First of all, to hedge risks, we want to take short positions in the S&P 500 because the S&P 500 and the stock portfolio are positively related. That's given by the positive beta coefficient of 1.5. And therefore, the futures position will earn some money and protect us if the S&P 500 and the stock portfolio decrease in value. And our formula from page 41 tells us that the number of short positions should be the beta, the risk exposure, which in our case is 1.5, multiplied by the value of what we try to hedge divided by the value of one futures contract. So let's look at our data. So the beta is 1.5, the value of what we try to hedge is $5 million stock portfolio, and the value of one futures contract is this $250,000. So let's plug in. The number of short positions which we short sell is 30.3 futures. Notice that entering this short position doesn't cost us anything at the initial point, and so there is a zero cash flow at time zero. Now the next thing which we want to look at is how well does our hedging position works if in 3 months the S&P 500 index drops from 1,000 points to 980 points. First of all, we could compute again what is the futures price. I already give it here in the question, it's 977.55 index points. But we could compute this again as the price of the underlying asset is 980 index point of the S&P 500 multiplied by e to the power of, and we assume the risk-free rate is still 1%, minus the dividend yield, which is still 4%, but now there's only 1 month left to maturity. So for simplicity, we're going to ignore daily settlements and reinvestment of daily payoffs. And all we're going to do is we just look at the cumulative change in the futures price between time 0 and 3 months. And therefore, the short position earns an amount of money equal to the futures price at the initial date of 990.05 index points minus now the new futures price in 3 months, which is 977.55 index points. And notice that each futures contract is written on $250. And we also have to multiply that by 30.3 number of contracts which we are actually short selling. So this gives us a payoff in these short futures positions equal to almost $95,000. Again, why is this a positive payoff? Well, because the S&P 500 dropped, and so the futures price dropped, then as a short position, you actually earn money. Now, in addition to this payoff in the futures contracts, we may also wonder how much does the value of our stock portfolio of $5 million changes as the index drops from 1,000 to 990 points. And to do that, we'll use the CAPM relationship, where we have that the return on our stock portfolio is equal to the risk-free rate in the market, plus some potentially abnormal return of the stock portfolio, plus the risk exposure of our stock portfolio to the market, multiplied by the market return, minus the risk-free rate, plus the idiosyncratic risk. Now, in our question, we say the stock portfolio is well diversified, so this idiosyncratic risk is 0. And we also assume here that there's no abnormal return of the stock portfolio, so we set that alpha equal to 0. And in our question, the risk-free rate is 1% per year, and the beta is 1.5. And now all we need is also the market return per year, and again, the risk-free rate is 1%. Now, how do we calculate the market return? So we know that the index started at time 0 at 1,000 points, and after 3 months, the index is only worth 990 points. And therefore, if you bought 1 unit of the index, then what is the return after 3 months? Well, actually, if you buy 1 unit, you're going to end up with e to the power of the dividend yield of 4% times 3 months, number of units after reinvesting the dividends. And then each unit is worth $990. So this is the amount which you have in 3 months divided by the initial investment for 1 unit of the index of 1,000 index points. That gives you that effective returns over the 3 months. And now if we want to figure out the annualized market return RM, then we can set this equal to e to the power of this annualized market return times 3-month investment horizon. So that gives us RM equals to 1 divided by 3 months times the natural logarithm of e to the power of this 4% times 3 months. That's the number of assets which you have if you bought one initially and reinvest dividends over 3 months, times $990. That's the value of the index after 3 months, divided by the $1,000 initial investment, and this is equal to minus 4.1%. Now we can plug this into the CAPM relationship, and therefore the annualized return of our stock portfolio is minus 6.6%. What does this mean for the $5 million? So we started with $5 million initially. They grow at an annualized return of minus 6.6%. So after 3 months, we have the $5 million times e to the power of minus the 6.6% times 3 months. Again, since this was an annualized return. And this is $4,917,911. And therefore, the change in the portfolio value is equal to $82,089. Now, if I combine the gain in the futures position of $94,668 and the loss of $82,089 in my portfolio value, then this combined payoff is $12,500. So the question now is, why do we get actually this positive payoff? Well, first of all, we try to do a hedge which gets rid of as much risk as possible. And again, what do we start out with? We start with an asset value of 5 million. The hedging itself doesn't cost us anything. But if we were able to get rid of all the risk, then the 5 million would effectively be invested at the risk-free rate. And so we should still earn a risk-free return on the $5 million. How much would that be? Well, the risk-free return on the 5 million would be the 5 million multiplied by e to the power of the risk-free rate of 1% times 3 months minus 1, which is equal to $12,500. Notice that this is now very similar amount to what we get with our hedged position. And indeed, this suggests that our hedge works really well. Notice that it is not perfect, and the difference in these values is not because of rounding errors, but because we still have this maturity mismatch, and there's actually a little bit of basis risk. Now, the basis is relatively small because that price drop from 1000 index point to 990 index point is only a 1% change. And so the mismatch between the futures price change and the stock portfolio change is not that large. If you would go through this example again, and instead of looking at a 1% drop in the index, for example, by a 10% drop, so from 1000 to only 900 index points, and you do all the math again, as we did just now, then you would see that this hedged amount can be actually quite different from the 12,500 risk-free profit, which you could get on this $5 million. So there, then you would see that that basis risk can be actually a little bit larger. On the notes, I write that equivalently. I look here at the combined position, which again is this $12,500. And then I look at what is actually the continuously compounded return of this $12,500 on the 5 million originally invested. And that's pretty much 0.25%. Now this is earned over a 3-month horizon. So multiplied by 4, that gives me a return annualized of about 1%, which again is the risk-free rate. So we already talked in general about when should you use hedging. Now let's focus particularly about hedging a stock portfolio. So you may ask, why do I actually want to hedge? In that previous example, that $5 million stock portfolio for these 3 months, if I could just sell it and invest the $5 million at the risk-free rate. Well, one of the reasons could be to avoid transaction costs. So if that stock portfolio has a lot of stocks in there and maybe a lot of small stocks, if I sell them, then maybe I have to pay a lot of money in brokerage fees and bid-ask spreads because there's not a lot of liquidity. And so this could be quite costly. And if I actually want to hold that portfolio again 3 months later, it might be much cheaper to just use a futures contract to temporarily hedge the risk. Another reason could be that maybe my stock portfolio actually has some abnormal return. So going back to that CAPM relationship, if that alpha here was not 0, but if that was actually a positive number, then hedging the market risk for 3 months and collecting still that abnormal return by holding that stock portfolio would make a lot of sense. Now, instead of getting rid of as much risk as possible, we could also just temporarily change our CAPM risk exposure beta. So not setting it all the way to 0. So implicitly what we did before is we said, well, we started out with a CAPM beta, in the case before it was 1.5, and we took these 30.3 short positions in the futures contract to reduce the beta all the way to 0. So we get rid of all the market risk. Now we could think about another scenario where we would want to change the original market risk exposure to a new target market risk exposure beta star. It turns out that the formula takes a very similar form as before. It will be just the beta where you start out with minus the target beta which you want to have, multiplied again by the value of the position which you try to hedge, divided by the value of one futures contract. Now you see that this formula actually nests the previous formula. Previously, we said we want to get rid of as much market risk as possible. Therefore, our target beta was 0. So that would just recover the formula from before. Now notice that if our original beta is positive, so we had a positive market exposure, and if we want to decrease the market exposure to a smaller amount or potentially even negative amount, then our number n will be a positive number, and this will tell us we will take a positive number of short positions in the futures. Now, in contrast, if we actually want to get even more market exposure, so we want to increase beta even further than what we had already, then our number over here will actually be negative, okay, because beta star is now larger than beta s, and taking a negative number of short positions is really the same as just taking the absolute value, so a positive number of long positions in the futures. So let's consider again the question from before. Instead of eliminating all the market risk, we want to just reduce our exposure to a beta of 0.5. So now our formula will be, well, our original beta of 1.5 minus the target beta of 0.5 times, again, this value of the portfolio which we try to hedge, divided by the value of one futures contract. And we should use 20.2 short positions in the futures for hedging that risk. And this makes a lot of sense. Before we said to hedge exactly all 1.5 points of market risk exposure, we needed 30.3 short position in the futures. Now we only move 2/3 the way towards 0. So we only need 2/3 of these short positions to eliminate only partially that risk. Now, what if instead we want to increase the market beta to 2, meaning we take actually on more market risk exposure because maybe we are very bullish about the stock market? Well, then again, we just plug into our formula. Initially, we had 1.5 market beta. Now we increase it to 2. So now this is a negative number of 0.5, or in other words, we have now minus 10.1 short positions, or this means now we take 10.1 long position in these index futures. So we don't actually hedge risk, but we actually take on more leverage. Now, why would you want to do that? Why don't you just put more money in that stock portfolio? So potentially we cannot borrow more money and invest it in that original stock portfolio, or it's just very costly to do that. So this way we can very cheaply take on more leverage. So this goes back to what I said before. When managers are bullish, they may want to increase their target beta and take on more market risk. If they are bearish, or if they're just worried about the market volatility, that they want to decrease their market beta closer to 0, or maybe even to a negative amount to hedge more of the market risk if they are very bearish. Let me just give some more remarks about stock indices so that we get a better understanding of how they work. So a stock index is a number computed from values of underlying stocks. So in some sense, it is a hypothetical portfolio. However, an index is never denoted in an actual dollar amount, but always index points, because it may not give you an actually tradable return. When we construct an index, we have to make a few different choices. First of all, we have to decide of what assets or what stocks we want to include in that index. So for example, do we want to represent the market of an entire country? Do we want to represent the overall world market portfolio? Or do we want to focus on a certain industry, for example, the tech industry, or versus, for example, the health industry? So there can be many different choices of which stocks you want to include. Once you know which stocks you want to include in an index, then you want to decide how to weight the different stocks in your index. And so there are many different choices. For example, the Dow Jones Industrial Average Index, which is very popular in the US. That's a price-weighted index. So here you basically just take your stocks and add up all the prices. And this is kind of funny because here you give more weight to a stock which has a very high price, but may not necessarily be a very important stock in the economy. So for example, you can think of a stock which has a relatively small market value, may have still a very high price because there are just not a lot of stocks outstanding. Because at the end of the day, the market value is the price of each stock times how many stocks are actually issued in the market. On the other side, you may have a company which is very valuable, so very high market capitalization, but the stock price might be very small because this company has issued a lot of stocks. Then in contrast to the price-weighted index, we have value-weighted indices, and that's, for example, the S&P 500 index, which represents the US stock market, and actually also many other indices across the world, like the Hang Seng Index in Hong Kong, the Swiss Market Index in Switzerland, the FTSE 100 Index in the UK, or the Euro Stoxx 50 representing the European stock market. Then we also have equally weighted indices, for example, the S&P 500 equally weighted index. Here you give just complete equal weights to each stock, and in comparison to the value weighted index, that means you give relatively higher weights to small companies and relatively smaller weights to big companies. There are many different ways to invest in an index. Either you could hold all the individual stocks in the index and in that sense replicate that stock index, or you could give money to a fund which tracks the index, and the fund then will buy all the underlying stocks of the index to replicate it. And this could be either through a mutual fund or through an exchange-traded fund. And exchange-traded funds have gained a lot in popularity since the 1990s when they were founded. Exchange-traded funds are cheaper than mutual funds, and the difference between mutual funds and exchange-traded funds is that with mutual funds you give your money to the manager and he then invests it on your behalf. And when you withdraw your money, you have to again call that manager and say, I want to get my money back. And the manager then sells again a portion of his portfolio and you can withdraw your money. Typically, these investments and withdrawals, they only can be done once a day, and so there is a little bit limited flexibility. There is also some risk for this mutual fund because when he has to buy and sell new assets in his fund, then there are some transaction costs incurred, and that actually increases the cost to operate the mutual fund. In contrast, an exchange-traded fund holds a fixed amount of assets, so for example, stocks in an index, and then they issue shares as a percentage of that ownership of their entire portfolio. And these shares are then traded in the market. So if I want to invest in that exchange-traded fund, I would buy directly a share of that index. And if I want to withdraw my money, I would sell that share to some other investor who want to invest in that fund. So in that sense, the exchange-traded fund doesn't always have to buy and sell the stocks in its portfolio when someone invests or withdraws money, and therefore the exchange-traded fund can reduce the operating costs. Now, of course, if in secondary markets the value for exchange-traded fund shares are different than the actual value of the fund which the exchange-traded fund holds, then there are some big financial institutions which can work as underwriters, and they can actually either inject or withdraw some money from the exchange-traded fund at one particular point in time and exchange that for some of the stocks which are actually held in the portfolio. So these financial institutions, which have this right to directly trade some of the underlying stocks for some cash with the exchange traded funds, they will basically equalize and make sure that there is no arbitrage relationship between the share price of the exchange traded fund which is traded versus the actual value of stocks which the exchange traded fund is holding. Then finally, you can invest in an index by trading a derivative written on that index. For example, you can trade futures contracts traded on an index or some options. Notice that nowadays we both have derivatives written on, for example, the S&P 500 index, as well as on the shares of the SPDR ETF, which tracks the S&P 500 index. Just to talk a little bit more about price versus value versus equally weighted indices. So as mentioned before, the Dow Jones Industrial Average, that's one example of a price-weighted index. The Dow Jones Index used to be the most popular index in the US. Nowadays, I would argue it is the S&P 500. The Dow Jones Industrial Index only consists of 30 very large stocks in the US, which are arguably the most actively traded stocks. And this index is very easy to replicate because you can just buy one unit of each of these stocks. And because it is a price-weighted index, in other words, you just add up the prices of all the stocks in that index, it is actually fairly easy to replicate. So you can just buy one unit of each stock. Notice, however, when there are dividend payments or if there are corporate events like mergers, acquisitions, or stock splits, then you actually have to readjust your portfolio. Notice also that the Dow Jones Industrial Average actually doesn't account for dividend payment. If you look at the change in the Dow Jones Index since its inception in 1896, then it was at almost 41 index points, and until mid-2012, the Dow Jones Industrial Average has grown to almost 13,000 index points. However, if you actually were considering to reinvest all the dividends, then the Dow Jones Industrial Average would have grown to over 250,000 index points by mid-2012. So that would be about 20 times as much. Therefore, it is important to remember that the Dow Jones Industrial Index and actually many other indices, as for example the S&P 500, when you look at the index itself, you miss the actual dividend payments. How big are these dividend payments? They are about 4% per year. So the Dow Jones Industrial Average had an increase by about 5.5% per year historically, but if you also would have considered dividend payments, then the return would be about 9.5%. So this is a very big difference, which you're actually missing by only looking at the index numbers. As mentioned before, value-weighted index, here you give more weight to a stock which has a high market capitalization and less weight to a stock with a low market capitalization, and therefore is really more representative of an actual market portfolio. So we really want to use these value-weighted indices when we use them as a proxy, as a market portfolio in the capital asset pricing model. Again, in many countries, we do have value-weighted indices. The most popular one in the US is the S&P 500, and in other countries, we also have representative indices which are value-weighted. Finally, just to give you a quick overview of futures trading on stock indices. Well, the first thing is that stock future indices are settled in cash. So that means at maturity, you look at how many index points is an index worth, and then you compare that to the futures index price and you calculate your payoff. First of all, you cannot trade an index by itself, but you could only trade a replicating portfolio of an index. And second, it wouldn't be practical to actually have delivery of an entire portfolio of 500 or more stocks at the maturity of a futures contract. So settlement in cash makes a lot of sense. Trading of futures indices started in February 1982, and the first futures in the US were actually traded on the Value Line Index, which is an index of 1,500 stocks in North America. Moreover, later in 1982, the Chicago Mercantile Exchange also introduced futures written on the S&P 500, and this actually has then become the most popular contract, which we see nowadays traded in the market. Also in 1982, the NYSE Composite Index started trading futures on the New York Futures Exchange. In mid-1984, the Chicago Board of Trade began trading futures on the Major Market Index, which is an index of 20 large stocks in the US. But it actually took until much later, until 1997, until the Dow Jones Industrial Average allowed trading derivatives on its index. For some reason, the Dow Jones thought they are somewhat special and they wanted to get a higher commission for allowing exchanges to write derivative contracts on that index, but that kind of backfired for them because derivatives on the Dow Jones are much less popular and much less actively traded than derivatives, for example, on the S&P 500. And overall, the Dow Jones index, I would argue, has lost a lot in popularity and relevance compared to the S&P 500 index. Notice that stock index futures are a big innovation in financial markets, and they have helped many different investors, ranging from mutual funds, pension funds, endowments of charities and NGOs or governments, insurance companies, and many other money managers. And this concludes the discussion of our chapter 4.